Aloha, inspired moneymakers. Welcome to Inspired Money, where we talk about everything from mastering your money mindset to investments and more. I'm your host, Andy Wong, financial advisor at Runnymede Capital Management, and I'm so glad that you are here with us. I love today's topic of financial resilience. I'm looking forward to getting into it because we all know that success is rarely a straight line. We've heard the story of Steve Jobs, who was ousted from Apple in 1985 and returned in 1996 at a time that Apple reported a net loss of $816 million, dangerously close to bankruptcy, before leading a big turnaround. Perhaps not as drastic, but most people's money is like that too. I'm sure you've made mistakes and you're going to stumble again. We all do. Building a strong foundation for the future requires resilience, the capacity to withstand or recover quickly from difficulties. You need to be tough. Before we bring in our guests, I want to point you to two Inspired Money episodes featuring Brian Winch. He's the CEO, author, and creator of Clean Lots, America's simplest business. Brian has been involved in all aspects of the parking lot litter cleaning business since 1981. He makes over $650,000 a year, napkins and coffee cups from commercial properties. If you're interested in starting a profitable side hustle, I encourage you to check out Inspired Money episode 150 or episode 199. The first one was an audio-only episode, and the second one is a video episode. I love his inspiring story of starting and operating a simple business based from home. It has nothing to do with AI. Or, as he says, it's a job that is almost as easy to do as going for a walk. He also sells a manual that guides you from establishing a company to winning contracts. Visit inspiredmoney.fm/cleanlots. This is an affiliate link. If you click the link and buy the book, Inspired Money will receive a small commission. You'll pay the same fee for the book, whether you click through or not. It's a really great story, and it's worth checking out. Now, let's welcome in our panelists. We've got Lynnette Khalfani-Cox, the money coach. She's back. She's renowned for being a personal finance expert and a best-selling author of at least 15 books. I've lost count. I know that includes Zero Debt, and her newest is Bouncing Back. With over 1,000 TV appearances and commercials, she owns the moneycoach.net LLC. and provides financial education services and strategic counsel to organizations worldwide, specializing in topics from credit and debt management to entrepreneurship and wealth building. Welcome, Lynnette.
Thank you for having me again. It's 16, but who's counting? Hey, Bounce Back is number 16. Yes.
I knew I counted wrong.
You got it right. You said at least 15, so you were there.
And with 1,000 TV appearances, you are everywhere. This is like your third session
one today. Yes. So it's fun.
So great to have you. Tanja Hester is an influential author and activist known for her impactful retirement advocacy and progressive financial education through award-winning books like Work Optional and Wallet Activism. She inspires others to embrace financial independence while advocating for inclusivity and diversity in personal finance. Tanja, I've seen you speak before at FinCon, but it's so good to have you here.
Yeah, I'm super stoked to be here. Thanks for having me. And I've only written 2 books. I feel exhausted thinking about I'm not by 8. Yeah.
Lynnette is a force.
That's been a lot of years. So.
And then rounding out the panel today, we have Denise Li, a personal finance coach, educator, and author. She draws inspiration from her upbringing and experiences to empower others to achieve financial freedom. Through her book, The Ocean Accepts All Rivers, Life and Money Lessons from My Taiwanese American Upbringing, and ongoing blog and live events, she continues her mission of transforming and inspiring individuals to take control of their financial futures. Denise, thank you for saving the day and coming on at the 11th hour.
Of course. I'm happy to be here. Looking forward to the conversation. And I've written that one book, so.
I love that title. Say that title again, Andy. The ocean
The,
accepts
the
all
ocean accepts all rivers.
rivers. I'm gonna get that just on the title alone. I'm like,
It's a great book. I've read it, and we'll get into it. I've had some
okay, good.
curveballs thrown at me today. This is very much a live podcast these days. We had Tiffany Aliche, the budgetnista, booked on the show. Unfortunately, she couldn't make it, so I'm going to be rescheduling her for a future episode. And then at the last minute, I was trying to get past guest Aaron Hale on. He's a decorated Army Staff Sergeant. He was I'm going to say it wrong. He was an EOD tech, which stands for Explosive Ordnance Disposal. He was injured by an IED in Afghanistan. But I was hoping that he could come on and share some lessons about resilience with us. Unfortunately, he's having a tornado warning and lost his internet. So we will continue, and the show must go on. We have a great panelist, nevertheless. So let's get right into segment 1. Understanding financial health is crucial for resilience. Start by evaluating your net worth. List assets minus liabilities to reveal your financial stance. Next, analyze cash flow. Review income versus expenses to ensure a positive outcome, identifying areas where you can cut back. Confront debt levels by compiling all owed amounts. Prioritize repayment based on interest rates to tackle efficiently. Setting financial goals are also vital. Define clear, achievable targets with specific timeframes. Strengthening financial health involves creating a detailed budget to track spending and increase savings. Building an emergency fund is essential. Aim for 3 to 6 months worth of expenses to cover unexpected events. Lastly, reduce debt through strategic methods and increase your financial knowledge through various resources. This approach lays a solid foundation for enduring financial stability and growth. Tanya, get us started, because you and your husband retired in your 30s. Sometimes I heard keeping your house at 55 degrees. So you guys are willing to be extraordinary in order to save 30 times your annual spending. What lessons can you share with us on your path to retiring early?
Yeah, it's so funny. The cold house thing tends to be really the thing people want to lead with because it sounds so wacky, which I admit that it is. For those who are seeing the live stream, you can see my wood paneling. We live in the mountains in the Sierra Nevada in California near Lake Tahoe, and it's really cold here in the winter. And because it's a rural area, fuel costs a ton, like to heat the house. And I don't want to pay for that. But we also have environmental beliefs. And so it aligns well with not heating the house too hot. And we realize, we can just wear a lot of sweaters and stuff. But if you know that about us, you probably assume that we never spend money on anything and never travel and only eat rice and beans. And that stuff is not true at all. We just really believe in picking a couple of areas where you can be, a phrase that I think some folks have used is selectively hardcore. And I really like that, picking 1 or 2 things where you can be maybe a little wacky, but you don't have to be like that in every part of your life. I have lots of tips I can share, but I think it's kind of a fun challenge to think about, to kick us off to say, is there one thing in your life where you could be that wacky person? But just one thing, or maybe 2 things, but not all the things. It doesn't have to be an all or nothing proposition. I think that's the biggest lesson that I repeat over and over, both to other people and to myself, is just, okay, we can trim this back without having to live like hermits in all areas.
I like that one. And actually, as an experiment one time, when my wife went away on a trip somewhere for like 3 or 4 days, as an experiment, I challenged myself by keeping the heat very, very low. And I put on a ski hat and I had like 2 blankets and I survived. And then I forgot to check the heating bill to see if it actually had an impact or not. My wife got back and she was like, "You're crazy." I said, "Well, it's kind of fun."
I think that's a great experiment. I think, a lot of folks don't give themselves enough credit for their ability to adapt. And this applies, I think, for a lot of folks where it's hot in the summer and you might use air conditioning. We don't have air conditioning in the mountains. And so not that we don't need it, but we kind of suffer through. But people who live in humid places and hot places, I think trying to crank it up gradually so that you're using less and less is a good challenge. But I think the best tip for folks who want to play the thermostat game is go gradually. Like you just plummeting it for 4 days, you have to give yourself time to work up to it. Like every fall, we have to give ourselves a couple of weeks when we're pretty uncomfortable, and some days we're cranking it back up to 60 because we're not quite adjusted yet. So I think just know that that's par for the course.
I like
I'm
the
laughing.
experimentation.
I'm laughing because my mom is staying with us right now. My mom is 80. She had knee replacement surgery in February, and we brought her here to the Houston area to have the surgery and to, to make sure that she recuperates well before she goes back to Georgia in June. And my mom likes the house hot, like really super warm. And we're already in an area that is warmer than her area in Metro Atlanta. But she keeps telling us this house is way too cold. So I went to the store. I bought her sweaters. I'm giving her blankets and all of this. Yeah, it's a funny thing to do when you have people who have different, temperatures and affinity towards, hot or cold, so.
And we have to live with our families.
Yes.
Yes, and you want to get along with everybody.
You want to get along, yeah. So, balance keeping the peace and saving the money. I don't know, so.
Lynnette, in your book, Bounce Back, you go through 10 common challenges people face in their day-to-day financial lives. How does one define and develop resilience?
Well, in Bounce Back, I do talk about these 10 areas. And I call them the dreaded Ds: downsizing from a job, divorce, death of a loved one, disability, disease, debt, damaged credit, dollar deficits, natural disasters, and then discrimination. And one of the things that all of these challenges share in common are the strategies and the prescriptions for how people recover and achieve resilience sooner and better. And one thing we know from a body of research into resilience, et cetera, is that it's not just about the individual kind of gutting it out, even though grit and personal fortitude play a role, but it's also about support. It's about the structures, the systems that people have in place that give them the capacity for resilience. And so I really took pains in Bounce Back to let the first couple of chapters not really deal with money at all. The first couple of chapters are focused on emotional and sort of mental health and well-being for the individual overall, talking about self-care, the importance of connection and having the right people in your life, those kinds of things. And so I think all of those, whether it's having the resources, the social connections, the information that people might need, et cetera, having all that at your fingertips, that is what helps to build capacity. Certainly far more than just kind of willpower or internal kind of fortitude.
I love the idea of building capacity. Denise, drawing from the lessons in your book, because you do lean into like the cultural background and how that influences. So I'm curious, like for an individual from a diverse cultural background, how should they approach evaluating their financial health effectively?
I would say, first off, to know what's so with your finances and the environment you're in. So one of the things that I learned from my parents, since they're Taiwanese immigrants, they came as basically students, was to look at how you gain wealth where you are in the environment you're in. So in Taiwan, it's a different game than in the US. And they ended up asking each other questions, asking of the community and doing their own research in a way that I think a lot of Americans might not go to do because they just live here and they think that I think they take it for granted how the system works or does not work for them, such that when immigrants come, they're learning afresh. They have a blank mind about it and they're just gathering information. And I think in that way, my parents had that advantage of receiving that information. The ocean accepts all rivers is is a proverb in the culture, which means you just have a willingness to take it all in.
Mm-hmm.
And then you work with what you received. So you don't filter right away. You take it all in and then you go from there. And that's something that I think helps them to understand that 401ks are a vehicle that you have to proactively contribute to save for yourself. My mom was an entrepreneur, so she had a small business and she created the safe harbor retirement for her employees to protect them in a way where they didn't even know to protect themselves necessarily. She might have, a 19-year-old intern who doesn't know the value of such a thing, where he doesn't have to contribute anything. And she can just give him cash, but he doesn't know he has to sign up for it proactively to get it. And she would chase him to make him do it because that's who she is. She's a caretaking person. And so these kinds of things like insurance, that they're a vehicle to assure you financial safety in a way that you wouldn't otherwise be able to afford if you just were saving money for yourself for a situation to occur. So insurance is actually it's almost like a hack, right? To get more money or access to money in the event of an emergency. That's what insurance is. And so that's kind of something that I think my parents really understood early on and imparted to us a lot of that learning, but also the habits in the culture that we have is very focused on saving, right? Don't spend outside of your means. And it's common in a lot of cultures, I think, but they really lived it. My parents did not come from a kind of a refugee background. They came for the opportunity, but a lot of immigrant backgrounds do come from a refugee situation. So the mindset is different, but the savings mindset is always there. And my parents' willingness to delay that gratification and just, afford the house they could afford at the time that they were living there in order to build to get to the next big house, and so taking that patience along with them. A lot of the proverbs of the culture that's how I titled the chapters of my book. It's by proverb because the lessons there are for just setting yourself up to succeed by understanding where you are first, and then using the tools available to you that are around you. Yeah.
I love how your mom helped others and inspired you to continue doing the same. And your mention of insurance is the perfect segue for segment 2.
Risk management extends beyond insurance, encompassing comprehensive strategies for financial resilience. This includes the establishment of legal structures such as trusts and LLCs, which shield personal assets from unforeseen claims and creditors. Diversifying investments beyond traditional stocks and bonds, consider real estate, commodities, and private equity, reduces market volatility impact and fosters stable income. Managing debt effectively by minimizing high-interest obligations enhances financial freedom and flexibility. Healthcare planning is crucial. Beyond basic Medicare, explore healthcare savings accounts and long-term care insurance to cover unexpected medical expenses. Income diversification through avenues like rental properties or annuities provides additional security against job loss or pension fluctuations. Comprehensive legal and estate planning ensure your assets are managed according to your wishes in unforeseen circumstances. Together, these strategies forge a robust risk management framework, securing your financial future beyond conventional insurance measures.
So Lynnette, you mentioned the dreaded Ds. I know that includes death, disease, disability, disasters. The tendency is to shy away from these topics oftentimes. How do you coach people to actually address it?
Well, there are some things that people have thrust upon them and that they have sort of no choice but to deal with, right? So unfortunately, if somebody has lost a loved one, if they've gotten a pink slip and have lost a job, they're in the throes of that change. And so then it becomes really a conversation about how they process that change. And, I make the point of explaining to them that change is something that often happens suddenly. It is thrust upon you. And for a lot of people, it's jarring. But transition is something different. Transition is how you process the change that has happened externally. And transition is something that happens internally within you. and it takes a long time. It might be weeks or months. So many times we don't have to ask people to, kind of talk about it or to get there because they've already encountered it. Now, there are some things where you absolutely do need to have those conversations, whether it's natural disasters, planning for potential death, or even a divorce that somebody knows they're in a rocky relationship. And then you do want to have those thoughtful, timely conversations. I think the best strategy is really around asking questions, asking about potential risk factors. What would you do if one of you lost your job? What would you do if you were separated from your spouse or your spouse passed away? How would you handle it if a natural disaster struck? You live in an earthquake-prone area or a flood zone or a area that's prone to tornadoes. What would you do if one of those natural disasters struck? So just starting the conversations with questions tends to prompt people to say, ooh, yeah, I'm not exactly as covered as I think I probably should be. Your audio, Andy.
I was muted because my kids were leaving.
Oh, okay.
I wanted Denise to continue what she was saying earlier. Talk about insurance as a hack.
Well, it's the way to see it is you contribute your premium to having access to a larger pool of money. That's really what it is, right? On the simple basic structure of insurance, it's basically a lot of people crowdsourcing, almost like a GoFundMe, all the small contribution per month into a pool. And then when someone needs it for a qualified expense, which is what the insurance has been defined to protect, then that is when you would raise your hand and say, I need something. That's a claim, right, that you make to the larger pool. And this is just a way to shore yourself up against any financial risk that is associated with whatever you're shoring it up against. So in that way, that's how I see it as a financial hack. You can look or appear to be a wealthy person in the sense that when something happens to you, it doesn't destroy you financially. And it's only accessible through insurance to be able to have that experience, as opposed to just being completely screwed when you have an accident or go through something, and so that is what I mean when I say insurance is a hack.
No, it makes sense.
And Andy, you probably know better than all of us about other, ways in which people use insurance as a hack in terms of fully funding life insurance policies and then being able to tap into it and kind of borrow against it in a tax efficient way. I know some people do that, as a strategy as well.
Yeah, there are a lot of insurance products. One is an annuity, which I think, unfortunately, is too often sold to somebody who doesn't need it. But in my opinion, it fits for people who have longevity risk. Like, you can purchase a policy that gives you guaranteed income, and the longer you live, there's a point where you benefit. And that can help a lot of people, especially when analyzing what are your expenses in retirement. And then if you have a level of income, guaranteed income, that can bring you peace of mind. I want to ask Tanja, finding affordable health insurance is one of the biggest challenges of the FIRE lifestyle. Can you give us the real lowdown?
Yeah, I think the reality is that it's probably better than most people think. And the reality is also that it's actually pretty easy to find out. You can go onto healthcare.gov, or your state may have its own healthcare exchange, and you can put in sort of imaginary scenarios. So you can say, I think I'm going to retire in 5 years, and at that point, we expect to have an income of X amount, and here's our family size, and the ages will be, and then it will tell you what that health insurance will cost in your area, and then you can plan for that. I do think it's good to plan for it to go up faster than the rate of inflation, because historically it has. Even in these last few years of pretty wild, out of control inflation, healthcare has still exceeded that. So it's good to model higher healthcare spending into all of your healthcare and financial planning. But the fact that we've got this great tool out there to let folks know what they can expect to pay, I think is a really great thing. Honestly, it's the thing that makes the entire early retirement movement possible, or work optional movement, as I think of it. Because before we had the Affordable Care Act, there was really no way that most individuals could even buy health insurance. It wasn't an option. So it's a great thing for people who want to retire early, for people who want to freelance, for people who are out of work for an extended period through no fault of their own, and they're just looking, it's great to have access to it. And a good thing to keep in mind also is that the income that counts for it is only essentially your taxable income, if you think about it that way. So if you have investments and you're living off those investments and you sell shares, it's not counting the whole amount that you sell, which might be what you're living off of. It's only counting the gain in value, or the capital gains as the income, and your cost basis, what you originally paid for those shares, doesn't count in that income. So for a lot of folks in the early retirement scenario, especially, your income on paper is going to be lower than what you actually have to spend. And that, I think, is really helpful to keep in mind, because that's something that a lot of folks forget. And at least right now in the US, we have pretty good tax credits that you get for insurance. So a lot of folks have more to spend than they technically earn, and therefore look relatively low income on paper. But I think even for folks who aren't in the early retirement or work optional sort of path, just knowing kind of, okay, if I was out of work for 2 years, what would my health insurance cost? That's just really good information to have. Sometimes it can be a wake-up call, and sometimes it can be a reassuring thing. But I think it's also good to think about insurance as beyond products, as being things that you can build into your own plan. We think of it as contingencies in ours. So knowing that, okay, right now we live in a very high cost of living area. So if suddenly all of our investments were worth a lot less and we couldn't sustain our lifestyle, one of our contingency plans is we could sell our house and move to a lower cost of living area. We don't want to do that. California is great for us for a lot of reasons, and is actually very tax favorable for people who aren't earning a ton. Plus, we believe in taxation and all the things it pays for. So that's a whole other issue. But it works really well for us. But that's a contingency. We also do have one rental property, which we're not big into being landlords, but we bought it really to rent to a loved one who didn't have other good options. But we know that in a pinch, we could sell that. So things like that can also be forms of insurance that aren't technically a thing you buy and pay a premium for, but give you added security in your life. And so that's one of the reasons I tell people it's not always good to plan around your most bare bones budget and live in the tiniest house you can possibly have in the cheapest area, and have the lowest possible expenses, because then you have nothing left to cut. And having some things left to cut can be enormously valuable, and also really give you good peace of mind so you can sleep well at night.
And you can live better.
Yeah, and also that.
Until you have to.
Quality of life, yeah, for sure. Yeah.
Lynnette, did you have something to add?
Yeah, I was just going to add, just on the health insurance front, I think there's one other strategy that I would recommend to your viewers, because healthcare is so ridiculously expensive. Today we had, CPI numbers came out, and healthcare medical costs were among those that were up, yet again. But I think that for people who are working, one strategy that I think is vastly underutilized is going through unions. If you happen to be in any field where there's a union, you might see if there's something available for you on the healthcare front. So take moi, for example, myself as a case in point. Andy, you mentioned that I did, 1,000 TV interviews and done TV commercials and all that good stuff. And yes, that's true. But here's the thing. Obviously, the TV side is one element of what I do, but I actually do get paid to go on some of the TV stations when I'm doing my professional work. So if I'm doing talk shows, for example, I'm getting paid. And I'm a member of a union, which is under the AFL-CIO umbrella, and the union is AFTRA, SAG-AFTRA. So as it turns out, because I do a lot of media, I earned enough to qualify for union-provided healthcare coverage. And it was a phenomenal healthcare savings for myself and my family. because before we were paying, at one point it was $1,000, it went up to $1,200, then it was almost going to be about $1,500 per month, literally for three of us, for just myself, my husband, and our daughter, who's now 18 years old. Long story short, I got my health care this year is through my union, and it's $250 a month. So it's a huge, huge savings for us. And I was able to even add my son, the 24-year-old who's already graduated from college. But because of his age, he was able to be put onto this healthcare plan as well. So it just reminded me that, folks should ask, even if, you might not think of a direct relationship or a union in your field or line of work specifically, you might say, wait a minute, I do have a membership or an affiliation here, and maybe it's worth me exploring whether or not they offer healthcare coverage.
What a great tip.
That is a great tip. I'm tempted to go into acting now.
Hey, save yourself some bucks there.
You can get into SAG-AFTRA if you read your own audiobooks. Fun fact.
Yep. That is true.
Have you done that?
I have, although I looked at what the union dues were going to be. And in my case, they didn't make sense. But Lynnette, you do a lot more television than I do. So.
But you did the math.
and that's what counts. And by the way, for anybody who is, kind of interested in that type of thing, there's a ton of things, writing, editing, producing, on camera, voiceover work, commercials, social. There's a litany of categories that are covered under that umbrella. So if anybody does, performance type of things, I think it is worth investigating. And I'm a huge proponent of the union and unions in general.
Great tips all around. Let's go to segment 3.
Exploring the psychological aspects of saving, we uncover the mental hurdles and incentives shaping our saving habits. This analysis provides keys to fostering consistent behavior for financial well-being. Cognitive biases, including the pursuit of immediate pleasure over future gains, often derail saving plans. Similarly, loss aversion, where the fear of losing outstrips the joy of saving, can hinder setting aside funds. Mental accounting leads to categorizing money in ways that may not favor long-term saving. To combat these challenges, goal framing is crucial. Setting clear, attainable targets makes the abstract concept of saving more tangible and motivating. Automating the saving process removes the daily decision-making, ensuring regular contributions to your savings without constant oversight. Introducing rewards or milestones can boost motivation, turning saving into a rewarding activity. Leveraging social proof by aligning with peer saving habits and enhancing financial literacy can transform daunting savings tasks into achievable objectives. By addressing these psychological elements, we pave the way for effective, sustained saving practices, essential for a secure financial foundation.
Denise, the stereotype for many immigrants is that you're trying to spend as little money as possible because you're always trying to save for a rainy day. Based on your teaching and working with clients, what are common psychological hurdles that you see affecting people's spending habits, and how do you help them to overcome them?
The biggest thing I would say is the concept of money scripts. And I didn't invent that. That was someone else made that up. But it's the idea that you have a belief system already with your relationship with money, whether you worship it or you're afraid of it, all kinds of ways that it affects your mental view of the money and how you relate to it. It affects your behavior. And that's usually the first thing I'll raise to my clients and let them know about to get self-aware of their own money scripts, because it really affects their willingness to look at their own spreadsheets or open their accounts or log in to look at something online. And they're afraid of what it means about them, right? They are telling themselves a story of what it means about them and their worth or their value a lot of the time. And so that's the first thing that I point out is the biggest hurdle is getting self-aware of your own personal money scripts. I will say that I have maybe it's a kind of like a money hoarding money script where I end up having this mindset that I have to the money's more important than me. That's how I treat money. And it's kind of a winning formula in the sense that it caused me to have more money than I need because I don't think I need it, right? Like it's not for me, but it also affects when I have a certain quality of life, right? I don't have a very good quality of life as a result of that. So that's something I'm personally working on, is actually spending more. It's really weird. That's my New Year's resolution every year, spend more, which is really weird for people, I'm sure. But that whole mindset of the money script will stop someone from saving if they believe that, only bad people have money. They had to somehow do something shady to get this money. And so if they have that viewpoint, sometimes they just spend very freely because they can't be holding money because only terrible people have excess, And so because of that, that keeps them in a certain financial standing that they can't get ahead of. And until they shake that mindset, they can't move forward, And so this is something that I'm always bringing up with my clients, is just get self-aware of that first, because the rest is math after that. The rest is going online and Googling something and learning more about a particular financial tool or product. And you can go from there. But until the mindset gets reset or self-aware, you can't really move very far from there. So that's something that I always flag for my clients.
Yeah, that's helpful. Tanja, within the context of FIRE or work optional, can you talk a little bit about the psychology of savings in real life?
Yeah. And, laughing hearing you talk, Denise, because my mom is also an immigrant, and I wish someone had told her that immigrants save money because she did not have that attitude, and I absorbed a lot of the wrong money lessons early on in life. So I think everybody has their own baggage around this, and some people do, Denise, what you do and hold on to money. I think many more people probably fall into the instant gratification camp, and life is hard and stressful and they just want some fun or pleasure, in some way. And so spend to try to get that, or do the aspirational spending of, if I buy this thing, then this is the type of person I will become, whether it's a new bike or whatever it is, that sort of aligns to the form of you that you want to be. And I think it's really helpful to think about your own psychology and your own money mindset. And if you're in a partnership, thinking about that alongside your partner to figure out what those differences might be, because we all come with all of these lessons that we've learned from early childhood, and they can be impacted by a lot of different things. And, one of my big bits of financial baggage is I just am so focused at all times on health insurance and making sure that we always have it, and making sure that we budgeted enough so that we can pay for it, even if it goes up to $5,000 a month. And that's because I've been sick since I was a little kid, and I nearly died multiple times. When I was born, I was in the neonatal ICU, and then I almost died when I was 8. And so that stuff is ingrained, and you're never going to pull that stuff out of me. And everybody's got their own version of that. And so pretending like I'm going to be a different person when it comes to finances is just unrealistic and isn't a way to set me up to succeed. But that said, even though I'm super focused on healthcare, I'm also inherently a spender. And so for me, I think one of the things that I really talk about a lot in, especially my first book, Work Optional, is the concept of hiding money from yourself. That's what I call it. And I think, Andy, in your intro video for this segment, you talked about thinking about different ways to automate saving, especially. And I think that's just so crucial, because I think there are a lot of folks who think, well, I'm a spender, I can't save. If I have to have all this willpower, I need to use my willpower on other stuff. I need to use my willpower on eating right, on not buying Cheetos at the grocery store, on, being a good parent, whatever else it is that you're aspiring to do in life. And then when it comes to the end of the day and I have to make some money decisions, all that willpower is gone. And psychology just bears that out. It says that that's true, that we only have so much. So for me, the answer for many of us who aren't inherently good savers is use that psychology and just take willpower out of it. So find ways that you can hide money from yourself. Maybe it's looking at your finances and saying, okay, at the end of each pay period, before I get the next paycheck, I tend to have $100 to $200 still sitting in my checking account. Well, great. Well, maybe you just take that out. So every paycheck now, you have $200 put into a savings account, ideally at a different bank so that you can't see it. And then that money is just kind of secretly building up slowly in the background. And it could also be what was, I think, a big part of our success, my husband and I, was we got to a point in our careers where we said, okay, we are comfortable at this level of spending. And sure, as we earn more, our friends are buying fancier cars or buying houses. We lived in a condo at the time, doing stuff like that. We said, we are good. We don't need to spend more than this. And so rather than try to scrimp, what we did is we tried to earn more and then funnel all the new earnings into savings. And so at the end of each year, when we knew, okay, here's how much of a raise we're getting, we just hid that money from ourselves. So it either went directly into retirement accounts or into cash savings or brokerage accounts. So it's just basically like your 401k, but not with the tax advantage, regular kind of stock or index fund accounts. And over time, those things built up, and we built up how much was going into them each month. And near the end, it was a huge percentage of our income was going into that stuff automatically, but it started very small. It started with me doing $50 a paycheck. And at the time, that was the most I had ever saved. When I looked at that after a few months and said, oh my gosh, I have $300. It doesn't sound like much, but for me, that was such a big inspiration. And so I think everybody has the capacity, even if you don't earn very much. It could be literally $5 a week or something. It has to be scaled for your own financial situation. But there are ways that we can all sort of be sneaky and just take the psychology out of it, or recognize your own psychology and your own weaknesses and the fact that we all have limited willpower, and don't fight against that. Just work with it and use technology and systems to your advantage.
I love that, hiding money from yourself. And I love it because the truth is that your psychology changes because there are external factors, there are all these influences. And if you're sitting alone, like in the middle of the night, and you can be rational and set up that automation, then you kind of know that, all right, the reality is that I'm going to be irrational because people are totally irrational, but it's okay. I can afford to periodically be irrational and be normal because you've set it up. So
Yes,
that's
so well
great.
said. And a lot of times with different companies, if you work for a company that has a 401k, for example, a lot of those have escalation options that you can activate. So when you set it up and you say, okay, right now I'm broke and I'm tackling some debt, and so I can't afford to do much, and I'm just going to do 3%. So I get my company match, for example. If that's where you are, you can set it so that at the end of the year, it will increase by some other percent. So maybe you go up a percentage point each year. So you start at 3%, next year it goes to 4%. And that happens in the background, and it tends to happen when your pay might change anyway. So you're less likely to notice it. And those, I think, are the moments that are the best. If anytime your income is going to go up, if you can look at ways to increase what you're saving so that it's just totally invisible, you don't ever miss that money, I think that's even more painless than trying to do it in the middle of the year or at another time when it does actually feel like you're tightening your belt. But it's like keeping your house at 55 degrees. You can sort of adjust to it if you just have the right motivation.
That's great. Lynnette, in Bounce Back, you suggest writing a letter to yourself from the perspective of a compassionate friend. Does that apply here?
I think so, but the idea was to sort of treat yourself the way that you would treat a friend, right? So a lot of times when we do something that is, deemed to be a mistake, or even in our own eyes, we feel like, oh, I screwed up, I messed up, how could I have been so dumb, et cetera, et cetera. We get really harsh with ourselves. And so the strategy, what I was trying to get people to do was to recognize how to practice compassion and self-care, and to talk to themselves the way that they would talk to a friend. So if a friend went off and just spent money because they were depressed or whatever, we wouldn't go, oh my God, you are such a bozo, why did you do that? We would go, oh, you must have been really feeling bad about something, or it would be a lot kinder in nature, and in the way in which we would talk to them. So I wanted us to kind of do that to ourselves.
I like that because I think that's part of the psychology, that ultimately you're going to make mistakes and you have to be willing to forgive yourself and move on. So be compassionate to yourself. That's great. Let's move on to the next segment.
Building financial resilience is essential for navigating life's unpredictabilities. Start by scrutinizing your expenses to uncover areas for cutting back. Direct these savings toward bolstering your financial base. Establish and pursue realistic saving goals, breaking them into tangible, achievable steps. Automate your savings, ensuring a steady flow toward these objectives without daily manual input. Address and reduce high-interest debt rapidly. This is crucial for enhancing financial freedom. Augment your income through additional projects or professional development, enriching your financial fabric. Establish an emergency fund to cover 3 to 6 months of living expenses, providing a buffer against unexpected financial shocks. Regularly evaluate your insurance to ensure comprehensive coverage against substantial losses. Invest time in expanding your financial knowledge to make well-informed decisions. Acknowledge and celebrate achieving your financial milestones. This reinforces positive behavior and propels you forward. Incorporate these steps into daily life to craft a robust financial foundation, enabling resilience and security in the face of unforeseen challenges.
Lynnette, I think that this segment is talking a lot about tactical things, but maybe you can share the emotional side of going through transition.
Sure. Well, in Bounce Back, I cited the work of Nobel Prize winning economist Daniel Kahneman. Unfortunately, he actually just died about 2 weeks ago. And he basically showed through his work, and a phenomenal scholar in so many regards, but he basically showed that 80% of all financial decisions are emotional, right? So even those of us who are like, I'm budgeting, I'm looking at the numbers, I'm making, statistical calculations here. Our spending choices oftentimes reflect our emotional state or our emotional needs. Sometimes it's the need for acceptance, the need for to demonstrate success, the need to satisfy a hole if there's unhappiness or depression or loneliness or whatever that's kind of going on. So I think that for a lot of people, it kind of starts with not only kind of recognizing where you are, but also recognizing like why you're spending or why you're doing a given thing. So it really all kind of gets back to the goals that you talked about a lot, Andy, that ultimately we really want people to kind of spend and allocate their money in alignment with their values, in alignment with their goals, and not just be willy-nilly in the wind, just kind of going about your everyday spending transactions, etc., subject to your emotional state, right? So I tell people all the time, if you show me your wallet, I can tell you what's really, or your checkbook, I can show you what's of value to you, and what you actually think most of, and what you find most important in your life, because chances are you're spending money on that.
I'm afraid to show Lynnette the receipts in my wallet. I'm going to hide those. Tanja, you and your husband, very successful in achieving FIRE in your 30s. To what extent does financial resilience come into play, like on a day-to-day basis?
It's funny because on a day-to-day basis, I don't know that it does, or at least it doesn't feel like it does, but I think that's because of the plan that we built. I say one of the biggest surprises of our post-career lives has been how little we think about money now. And that's, I think, a really important reward that folks don't talk about enough. That it's sort of like you assume, okay, I'm focused really hard on my budget and my line items and where all my money's going, and getting a grip on, are we spending too much at restaurants? Are we doing this? Are we doing that? And not necessarily thinking about what the reward is, other than just not having to go to work every day, which that alone is wonderful. And I highly recommend it to everyone who can possibly make it happen. But I think that it's also the freedom from sort of that level of concern, because we know that we have so many fail safes built in. I shouldn't say fail safe, because they could all fail, which is why we have multiple levels, but we have multiple contingencies built in. And I think the point that Lynnette was talking about is really important too, that the way that we think about money now is much more around our values. And we talk about money a lot. We'll talk about values-based spending, but most of the time when people say that, what they actually mean is what you value, not your values. And I think that those are sometimes the same. Like your values might say that you want to be a part of your local community. And so you might value spending money and time in your local community at the same time that your values say you want to support that. But sometimes these things are quite different. So like I value art supplies as a thing that I spend a lot of money on, but that isn't necessarily my values. My values are that freedom of expression is really important, and it's really important that we all get to, be present in the world and as our full selves. But those aren't necessarily exactly the same. And so it's sort of this distinction is why I wrote my second book, Wallet Activism, because sometimes if you say to folks like, oh, do you feel like your spending or your other financial decisions are in alignment with your values? Folks will say, no, but gosh, I'd really like them to be. I'd really like to know that the money I'm spending isn't going to people I don't want to support, or, bad regimes that are abusive to people, or I don't want my investments to be into things that are fueling climate change or things like that. And you say, okay, so are you going to fix that? And they go, well, I don't really know how, or it doesn't feel realistic. Folks always kind of whisper that last part. But I think it's actually a lot more realistic than people think. And that's, I think, if you're in a place in your life where you need to focus on paying off debt and getting an emergency fund, focus on that stuff. But if you're a little bit farther along and you're investing and you're saving and you're making bigger financial decisions like property purchase, I think it's really important to think about how you're expressing your values through your financial choices, because that is the way that we have the most impact in the world. And most of the things that we see around us in society are things we never voted on with our vote. They're things that we voted on with our dollars. And there's a lot that we can actually do. I think the system and the people who are currently in power benefit from us feeling not powerful, benefit from this idea that, well, I'm just one person, what can I do? But if you actually look at it, it's pretty incredible what each of us can do. And so I could scream that from the rooftops, but that's how I think about money these days. I'm not thinking about, okay, what are we doing or not doing with our finances? Because that stuff's been on autopilot for a lot of years now. We've just built those habits. But I am thinking about, okay, do we feel good about where our investments are living? Should we do some shifts there? Do we feel good about how we're spending money, how we're getting our groceries, stuff like that? But that's just, you have a lot of potential as an individual to make a difference. So I just really encourage people to think about that.
Thank you for sharing that. I love hearing that when you're hitting your goals, you actually find yourself talking about money less or less focused on the money. That's encouraging. That sounds like financial nirvana. So, Denise, can you talk a little bit about, like, do you advise people to address the high interest rate debt first? How do you suggest prioritizing?
Yeah, that's something I customize to each client. While it makes the most financial impact to address the high interest rate debt first, psychologically, it can be really intimidating if that's the largest sum on that card, perhaps, that person has. And so what works for that person is the one that gets them to pay the debt down in a way where they're empowered and they're not feeling overwhelmed, right? And so that's kind of what I usually say, that between the Snowball and the Avalanche method, where I ask the person which one would they like to go with, and these are the benefits of each, and let them to decide, and then I just hold them to that, right? Like check in, see how they're doing on it, and then celebrate those wins with them wherever they do tackle it, right? Because once they do see the numbers go down, and then they get, maybe one of the cards is $500 and they're able to get that one down, then the next card is 10,000, and that one would make the biggest impact if they get that, rush of, oh, I actually got this card off of my list. Sometimes that really motivates them to go even harder and go on the larger sum. And so that's depends on the person, and they might switch between during the time that we're working together, whichever tactic they go with. But either way, it's all in the right direction. And I always tell them, the neat thing about going with the higher interest rate debt first is also that whatever it took to pay that down, now when you get into net zero, where your net worth is $0, so you've gotten out of debt, at that point, each dollar you set aside is now worth that much more because that interest rate is now accelerating you. So it's in the opposite direction towards the saving. And so it's working for you now. And that's a way to kind of see the value of each dollar that they get to set aside from there, that the saving is even more pronounced. And so that's something I give them that vision to move toward as a way to just motivate them to go harder, faster once you hit net worth of $0. So
I like the advice because Denise, each of us is a unique snowflake. So
yeah, exactly.
So let's wrap it up. Let's bring it home and go to segment 5.
Embrace the power of technology to foster financial resilience. Use budgeting apps like YNAB or Empower Personal Dashboard, which help monitor spending, saving, and setting realistic budgets. These tools illuminate potential savings areas, driving informed financial decisions. Explore investment platforms like Robinhood or Betterment, designed for easy entry into investing, offering user-friendly interfaces and tailored strategies. These platforms make financial growth more accessible, demystifying the investment process. Incorporate automated savings tools such as Opportune or Capital, which subtly bolster your savings by analyzing spending habits and making small, unnoticed transfers to your savings account. This automation aids in building your nest egg effortlessly. Use debt management applications like Unbury.me to structure and expedite your debt clearance journey. These apps apply proven methods, ensuring effective debt reduction. Finally, elevate your financial literacy through platforms like Khan Academy or Coursera. Understanding the fundamentals of finance empowers better decision-making, enriching your financial well-being and resilience. Integrating these technologies into daily life paves the way for a secure financial future.
Tanja, when you were talking earlier about healthcare, it sounded like technology is really enabling people to go work optional because they have the tools. Do you have favorite apps or tech that help you to manage your money?
This is where I start to sound like such a person who's living under a rock. All of the tools that I use are a few years old now because I think it can sometimes feel overwhelming to look at what's out there and think, oh my God, I have to test drive 40 different FinTech apps. The answer is no, you don't. There are some good ones out there, and you can often just search to get recommendations from trusted third parties who review these things and can give you good advice on which ones are good for your particular purposes. But now really we're down to just kind of our bank mobile app and our primary investment bank app. And then we've got, I have my health insurance and I know where to go, to healthcare.gov to check out premiums each year for open enrollment. But, I've dabbled with several of those apps and they've been helpful at different times in our journey. But you also get to a point which I think is really promising and is, again, sort of the reward of once you've got things at a good place, you don't necessarily always have to be staying up on what the new apps are and what they're offering. It's more like when you're at a transition point and you need something new or a different tool, you can see, okay, what's available today? And the ones that I might list that were helpful to me 10 or 15 years ago are going to be really different from what's out there today. And that's great because I think we've got even more and better tools now. The only thing I'll say is just do be mindful of privacy on that stuff because things like there are stories all the time about celebrities whose Venmo is open and you can see what they've been spending money on. Or I know some people who've gotten identity scams by people being able to kind of piece together some clues on their Venmo and then act like they know them when they approach them. So I think with all of those things, anytime you're dealing with anything tech, be mindful of your privacy, because once you do get to a financially comfortable place and that's something that some people around you know, it does make you a target. So I think it's just good to be realistic about that and know that going in.
How about you, Denise? What role do you see technology playing in financial education?
So many. I work in cybersecurity industry, so you're singing my song, Tanja. And AI is actually something I'm very curious about and wary about, because we do need regulation around ethical use of AI. And so to my mind, the biggest thing is around security. Make sure that since it is related to your money, it's easy enough for hackers to get it. Luckily, the financial, a lot of regulation around security, such that it is highly difficult for hackers to steal your information and get your money. But that being said, and this is something I've kind of heard up when crypto was coming up, is that people were asking about it, and I just kept saying it's not regulated, right? The security of it isn't regulated. The moment someone gets your wallet, you got no recourse. And so there's a lot of opportunity in the fintech industry to have these tools that help you make things easier. There are, what I would encourage as far as the research is looking at how they make their money, so that you know if they're in alignment with you getting your money in order. And so it comes down to, for example, Robinhood as an app, right? The way that they make money is an interesting thing that kind of banks on our gambling addictions. And it's not actually a way to make money that makes sense to me for a company. And so just do your homework when it comes to whether the fintech app that you're using aligns with getting you rich, right? Like helping you get organized. And to not lean too heavily on it either, because ultimately it's the principle of the thing is just know where your money is, know what it's doing, and what kind of risk exposure it has if it's invested or something. And that's it. That's the basics. And so from there, whatever that looks like, it can look like looking at, like Tanya was mentioning, the third-party apps that do the reviews. They are doing a great job, I think, of doing that evaluation for us. But again, they are a third party that has this, it's almost like a consumer report for you, and then you do your own thinking, right? Your own critical thinking for your own use. Just like any shopping for insurance, you have your unique life, you have your unique goals for your life, and where you're headed isn't where everyone else necessarily is headed. And so whatever that is, whatever that looks like, the tools should serve you.
And Lynnette, final thoughts?
Well, I'm a big fan of fintech apps and technology, AI, the latter of which I agree with Denise. I think we absolutely need not only ethical guidelines and considerations around that, but need to make sure that it's developed in an inclusive manner and that in a way that doesn't harm people. Having said that, I think that for a lot of people, I see fintech as a time saver, as a money saver, as a way to kind of relieve a lot of the stress and anxiety associated with managing your own finances. And I do think that for a lot of folks who are looking for decision analysis and for kind of a collection of data to be assessed, and for them not to have to do it themselves, there's a lot of good apps and tools that can help them to do that. Everything from apps that are debt payoff apps that'll, look at your finances and tell you the fastest or the smartest way to pay your debt down, to various budgeting apps. You mentioned, obviously, Andy, You Need a Budget and Empower. Those are two good ones. I like Rocket Money as well. I like Rocket also because not only to help you to see with clarity what you're, spending, but also to understand the new subscription economy that we're all a part of, to see where you have recurring charges and those subscriptions that you might not have even realized, oh, wow, this is hitting my debit card or my credit card every month or every other month. And most people have absolutely no idea how much is going out the door with those kinds of charges. So I think that those apps can be helpful to give people financial clarity and insight into how they're managing their money or not.
That is great. Well, thank you to our panelists. Just some really quick takeaways, if I can read my handwriting. I love hiding money from yourself. I love automating. We talked about being kind to yourself and compassionate to yourself because you're going to make mistakes. And then vote with your dollars. Think about your values and what matters to you, and be thoughtful about where you're spending your money. And then I love that there are so many tools today with tech and apps, but also, once again, be thoughtful. Be sure that you're using it to your advantage and that you're not being taken advantage of. So I want to thank this fantastic panel full of women power who
Yes.
spent time with me, the lone guy here. I encourage everybody to follow and go find Lynnette Khalfani-Cox, the money coach, at LynnetteKhalfani-Cox.com. If you are not watching and you're listening and you can't spell her name, go to themoneycoach.net. Tanja Hester, you can find her books, Work Optional and Wallet Activism, or you can find her at TanjaHester.com. Tanja, what's your podcast right now?
Oh, I technically still have a wallet activism podcast, but I haven't posted there in quite a while. And to be honest, in early retirement, it's just much more fun to focus on art projects and my garden things. So those could come back at some point, but I'm not holding myself to a schedule. And for folks listening, it's TANJA. The J always throws people off with Tanja Hester. Hester is spelled the way it sounds.
Thank you for clarifying. And then we talked about Denise Li Thurman's. Wait, what's your married name? I messed it up. Thurlow.
Yeah.
Denise Li Thurlow. We talked about her book title, The Ocean Accepts All Rivers. Go check that out. Life and Money Lessons from My Taiwanese American Upbringing. You can find her at deniseli.com, and that's Lee, L-I.
Denise Wiley. Sorry,
Oh,
there's a letter Y in the middle.
Wiley.
Denise
Thank you.
Wiley, yes.
Thank you for the correction. Go to Denise Wiley. And thank you, Inspired Moneymakers, for joining us for another great episode. These panelists were absolutely fantastic. And be sure to come back. Inspired Money will be back next week. I think I'm not going to be Wednesday. I think it's going to be Thursday, April 18th, because April 17th is my anniversary. So
don't tell people that. That could be a password giveaway.
Don't use that as my password. Note to self.
Yeah, no password hints with your anniversary now. You've given it away.
Okay. Thank you for that. And that didn't come from Denise, who is the cybersecurity person.
No, good catch, Tanya.
I'm toast. Inspired Money will be back next week, April 18th. We've got The Art of Mindful Spending, Finding Joy in Financial Decisions. Until then, do something that scares you, because that's where the magic happens. Thank you, everybody.